Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone. We have a pretty dense stack of sources in front of us today. CNBC, Bloomberg, Yahoo Finance are all buzzing. Our mission is to cut through some of that noise and really deliver you the most important nuggets from this morning's global financial and geopolitical landscape.
And it feels like the market is really being driven by three powerful and I think interconnected forces right now. First, you've got this global anticipation ahead of the Federal Reserve's final interest rate meeting of the year. And there's some real drama surrounding the political risks that are already starting to shake up the bond market.
Right. And then second, we're grabbing our popcorn for what is, a true Hollywood saga, an escalating, really high-stakes corporate takeover battle that's raging in the media industry.
And finally, we're charting this incredibly complex and I'd say often contradictory landscape of AI regulation and international chip export policy. It's a place where the pursuit of profit is, well, it's running headlong into national security concerns.
Okay, let's unpack this. We have to begin where all things financial seem to start these days, the Federal Reserve. These macroeconomic forces are just dictating so much of the short-term investment strategy as we wait for Wednesday's big announcement.
The expectation is nearly universal across all the major financial reporting. Sources from CNBC and Bloomberg are all indicating that the market has overwhelmingly priced in another 25 basis point rate cut.
Okay, so for our listeners who might not deal in financial jargon every day, a basis point is just 1/100 of a percentage point. So what exactly is the market expecting here?
It just means the market believes the Fed is going to cut its target rate by 0.25%. The CME FedWatch tool, for example, it shows something like an 87% to 89% probability of this move, which would bring the federal funds rate target range down to 3.5% to 3.75%. This is so widely anticipated, that it's already influencing market behavior globally.
And what does that behavior actually look like? Because anticipation doesn't always mean green arrows across the board.
No, it's very mixed. U.S. indexes, they closed lower on Monday, and that kind of mirrored declines across most of the Asian markets. Japan's Nikkei 225 was a notable exception, though. It was buoyed by strong performance from some key tech stocks, particularly semiconductor names like Disco Corp, according to CNBC. Meanwhile, Europe, the stock's 600, it edged slightly higher in early Tuesday trading, so a lot of volatility. Everyone's just waiting.
The rate cut itself might be priced in, but we need to talk about the downstream effect for you, the income-seeking investor. This is really the so what of the entire policy shift, this dividend dynamic.
Absolutely. The so what is the mechanism. It's how lower policy rates actively push investors out of these safe fixed income products and into higher yielding assets like dividend stocks. An analysis from the CNBC Investing Club really highlights this pressure point.
Because when the federal funds rate is high, you can get a really attractive return with essentially zero risk in things like money market funds or, bank CDs.
Precisely. And we've seen this enormous migration of capital. We're talking about $7.65 trillion into money market funds since rates climbed. But those returns are quickly diminishing in anticipation of the Fed's shift. We're already seeing the yield on the 100 largest money market funds drop quite a bit. And similarly, the average rate on a 3-year CD is down to 3.6%, a pretty steep fall from earlier this year.
So as the yield on the safest places to park your cash shrinks, that capital, it's like water. It's forced to flow somewhere else to find a better return. It's just a fundamental principle of investing.
It is. Investors who need that income, retirees, funds, endowments, they suddenly find that those bank accounts and short-term treasuries just don't offer the competitive yield they once did. And that compels them to look at dividend-paying equities to maintain their required income. That flow of capital acts as a huge tailwind for those stocks.
But here's where it gets really interesting. While the short end of the interest rate curve is being pushed down by this anticipated cut from the Fed, the longer end, it's defying gravity. Treasury 10-year yields have actually climbed over 20 basis points since their October lows. Why is the bond market doing this? It should be falling if cuts are expected.
And this is where politics enters the equation. According to Man Group, as reported by Bloomberg, this rise in the long-term yield is directly linked to speculation over presidential politics. President Trump is expected to name his choice for the next Fed chair to replace Jerome Powell, and the frontrunner is reportedly Kevin Hassett.
Okay, so for the listener who doesn't follow Fed politics that closely, what does a potential Hassett appointment signal, and why does that immediately worry bond investors?
Well, Hassett is widely viewed as being highly supportive of the administration's preference for sustained lower rates. The concern isn't really about the cut itself, but about institutional independence. Man Group argues that if the market perceives the next Fed chair as politically motivated, as someone who might not raise rates even if inflation abandoned it, then investor confidence in the Fed's long-term credibility just gets undermined.
But wait, if they want lower long-term rates, wouldn't the market be happy about that? Why would a potential loss of independence actually increase yields?
Because bond investors demand a premium. They demand a premium to hold debt if they believe the central bank might just abandon its inflation-fighting mandate for political reasons. The perceived risk of future, uncontrolled inflation goes up, and that risk translates directly into higher yields. In a worst-case scenario, if the market truly loses confidence, the Fed might be forced into more extreme actions like quantitative easing, or QE.
And just to clarify for everyone, QE is when the central bank basically buys massive amounts of long-term bonds to artificially suppress borrowing costs, right?
Exactly. It's a blunt instrument. If cutting the short-term federal funds rate isn't enough to calm the bond market because of a credibility crisis, the Fed might have to resort to physically entering the market to buy bonds, that's QE, just to force those long-term borrowing costs down. This political uncertainty, and you see it in the yield jump since Hassett emerged as the frontrunner, it's one of the most significant non-economic risks facing the bond market today.
That is a fascinating look at the tension there. So if political considerations are shaking up the Treasury market, they are certainly driving the drama in Hollywood. Let's trade one kind of high-stakes maneuvering the Fed for another, the fight for Warner Bros. Discovery.
Oh, this is a full-blown corporate soap opera, the kind of M&A cliffhanger that keeps lawyers and bankers awake at night. Just last week, we thought this whole story was settled when Netflix announced a cash and stock deal to acquire key assets from Warner Bros. Discovery, or WBD. The price was $27.75 per share.
But Netflix barely had time to print the celebratory hats before Paramount Skydance just stormed into the ring with a hostile bid.
And what a bid it was. Paramount Skydance launched an all-cash tender offer directly to WBD shareholders at $30 per share. That's a significant premium. But more importantly, if you look at the total enterprise value, which includes all the company's debt, Paramount's bid is for $108.4 billion. That just completely overshadows the Netflix offer, which came in at about $82.7 billion enterprise value.
So the all-cash aspect and the inclusion of the debt commitment make the Paramount offer substantially larger than just the share price difference suggests. This isn't a negotiation, it's a hostile takeover.
It is absolutely hostile because Paramount is bypassing the WBD board, which had already given its initial blessing to the Netflix deal. The Paramount Skydance CEO, David Ellison, he made this strategy explicit. He told CNBC, "We are here to finish what we started." They're appealing directly to the shareholders with a better cash price, hoping to force the board's hand.
And that cash is backed by some serious firepower, I understand.
Absolutely. The bid is financially secured by $41 billion in equity financing from some major partners, including Redbird Capital and also Jared Kushner's affinity partners. So this is a highly capitalized, very aggressive move. The WBD board, however, is, for now, standing firm by the Netflix agreement. They've advised shareholders not to take any action at this time.
That puts the WBD board in such a tough spot. Their fiduciary duty to maximize shareholder value versus honoring an existing preferred deal. And there's a hefty price if they switch horses.
A massive price. If WBD shareholders are swayed by that $30 all-cash offer and the company ends up accepting Paramount's bid, WBD immediately owes Netflix a $2.8 billion breakup fee. That's a huge number that would have to be factored into Paramount's final calculations.
And it's a classic corporate messaging war, too. We've seen the CEOs trading jabs over what the deals are supposedly worth.
We have. Ellison called the Netflix deal anti-competitive in every way. Meanwhile, Netflix co-CEO Ted Sarandos, he took a shot at Paramount's promise of huge integration synergies, an estimated $6 billion. He basically suggested that those synergies are just code for massive job cuts. Sarandos countered that Netflix is making jobs, not cutting them.
That's a powerful narrative contrast. One side promises efficiency through cuts, the other promises growth and job creation. But in a hostile bid, which promise do shareholders usually prefer to hear?
Well, often cash and near-term shareholder value win the day, especially when the board is trying to stand by a lower offer. This M&A battle is just a perfect study in corporate maneuvering under pressure.
Moving from Hollywood drama to global policy drama, let's pivot to the rapidly evolving landscape of AI. This week brought a major and I think really consequential policy reversal regarding advanced chips in China.
This is massive.
Yeah.
And it really underscores the inherent tension between commerce and national security in this AI race. President Trump announced via his Truth Social platform that NVIDIA will now be allowed to sell its H200 AI chips, these are the more powerful advanced chips, to approved customers in China and elsewhere. This was also reported by CNBC and Yahoo Finance.
And this permission comes with a pretty unique fee structure.
It does. To get this export approval, the U.S. government will receive a 25% cut of the sales revenue from those advanced chips. This is a substantial increase from the previous 15% rate that was agreed upon for earlier, less powerful chips back in August. The administration is framing this as supporting American jobs and creating a revenue stream for the U.S. Treasury. And we also heard that Chinese President Xi Jinping responded positively to the deal.
So on the one hand, the government is generating revenue, they're promoting American exports, but on the other, analysts are sounding alarms about giving China access to cutting-edge compute power. I mean, that seems like a profound contradiction.
It is the central contradiction defining the AI geopolitical space. Analysts like Rush Doshi and Tim Fist, they argue that providing China with the H200 chips significantly erodes a core strategic advantage for the U.S., which is compute power. The belief is that the H200 is far more useful and effective than previously restricted versions. The argument is simple. If you give up control of the most advanced silicon, you increase the odds the world runs on Chinese AI.
That seems like a really clear conflict between profit and policy, and the irony is just amplified when we look at enforcement. Almost at the same time, the Department of Justice announced a bust against people trying to do the exact same thing the government is now sanctioning for a fee.
That's the part that is just stunningly complex. The U.S. Department of Justice recently announced they busted a huge smuggling network. They were attempting to traffic over $160 million worth of export-controlled NVIDIA H100 and H200 GPUs to China and other restricted areas. These people were charged with falsifying documents to evade the controls.
Wait, hold on. So the U.S. government is now selling the H200 chip to China and taking a 25% cut, while at the same time prosecuting smugglers for illegally selling the exact same chip.
That's the tension you have to unpack. The difference legally is control. The government is trying to convert previously restricted sales into authorized, profitable, and, trackable revenue streams. But the inherent moral hazard is just undeniable. When the state profits from the sale of sensitive technology to a strategic competitor, it raises fundamental questions about whether national security or short-term revenue is the primary goal.
And this political maneuvering did not go unnoticed on Capitol Hill. We saw an immediate, sharp response from House Democrats.
Yes. The House Democratic Caucus moved very quickly to establish the Commission on AI and the Innovation Economy. They're aiming to develop essential policy expertise in this field because it's moving so fast. And they openly criticized the administration's decision. Representative Ted Lieu stated that House Democrats reject this misguided approach, which risks leaving Americans vulnerable. They're also focused on the domestic regulatory structure, opposing Republican efforts for a single national AI standard, and preferring to let state-level efforts continue.
Moving across the big tech landscape, let's contrast these enforcement issues with the regulatory scrutiny that U.S. companies are facing in Europe. The EU's hammer, especially for big tech, it just continues to fall.
It really does. Bloomberg and CNBC are reporting that the EU has launched another abusive dominance probe, this time against Google. The core issue centers on its new AI tools, specifically AI overviews and AI mode. The concern is that Google is leveraging its market dominance to use web publishers' content to train and fuel these tools without, appropriate compensation.
This sounds like a case about market leverage and intellectual property rights in the age of AI.
Exactly. The EU is determined to ensure fair competition in this emerging AI search space. And this latest action, it follows a very distinct pattern. We saw that large ad tech fine against Google back in September, and a separate antitrust investigation was recently launched against Meta over its policy on how AI providers access data via WhatsApp. The message from the EU is clear. Even as technology evolves, existing competition laws are going to be rigorously applied to maintain fairness in new AI markets.
Okay, so now let's look at a completely different strategic play from a major tech player, Apple. They've largely avoided the massive capital spending of this AI arms race. Despite early criticism for a slow AI strategy, Apple's stock has actually soared 35% since June 2025, and that's according to Bloomberg. It's outperforming AI darlings like Meta, Microsoft, and NVIDIA in that period. What is the investment logic here for this seeming outlier?
Well, investors are seeing Apple as what one chief investment officer called a bit of an anti-AI holding. The strategy is defensive. While competitors are spending billions, maybe even trillions, on building out massive AI infrastructure, this CapEx arms race Apple is holding back. Investors are betting that Apple will profit later by being the platform that millions of people use to access AI.
It's a platform play. They're leveraging the ubiquity of the iPhone and the stickiness of its service ecosystem.
Precisely. They are seen as a safe place to hide amid concerns about a possible AI battle. The expectation is that future AI adoption will primarily drive device sales and boost its high-margin services revenue without taking the initial risk and massive expense of developing foundational AI models. The one caveat, however, is that the stock trades very high, around 33 times expected earnings. So investors are potentially paying a premium for that defensiveness.
Okay, let's wrap up our global outlook with a fascinating infrastructure concept being pioneered in the Middle East: data embassies. Saudi Arabia is positioning itself to become a major data center host and an exporter of data services.
A data embassy is a really novel concept. It's built around legal rather than physical boundaries. So a nation's sovereign data is physically stored outside its borders, but it legally operates under that nation's laws, much like a real diplomatic embassy operates on foreign soil.
So the concept is rooted in data sovereignty. A nation wants to ensure its data is safe, even if it's stored somewhere else.
That's the goal. Right now, only two small nations, Estonia and Monaco, have established data embassies, and both of them are in Luxembourg. They use them primarily for critical data backup. Saudi Arabia, however, is aiming to be the first G20 country to set up a comprehensive legal framework for exporting these services. They're leveraging this growing push for sovereign AI that requires data storage outside the US and Europe.
That sounds incredibly ambitious, especially given the lack of international legal precedents.
It is, and experts are expressing significant skepticism. Creating a data embassy framework requires these complex bilateral international agreements. And as Victor Mayer-Schonberger from the University of Oxford notes, these are heavily dependent on trust between nations. In a time when globalization and international trust are arguably waning, that's a major hurdle.
And the practical challenges for Saudi Arabia specifically are significant, and they tie us back to resources, which we were just discussing.
Exactly. Data centers require massive amounts of energy and, crucially, cooling water. Saudi Arabia faces acute water scarcity. And while they're pushing solar development, their electricity grid is still 64% oil-powered. So this goal of becoming a global data exporter clashes directly with the environmental realities of water scarcity and relying on fossil fuels for huge energy consumption. It's a compelling example of how infrastructure policy is always constrained by environmental realities.
So what does this all mean? We've covered everything from the political risk driving bond yields to the high-stakes corporate maneuvering in Hollywood. And we finished with a look at the future of sovereign data storage being constrained by, of all things, water treaties. Trillions of dollars in global capital flows are just waiting for the final word from the Fed, while these strategic tensions rise across the geopolitical tech landscape.
The discussion around AI, in particular, I think it raises the most profound question for long-term global stability. We see the ultimate competitive advantage in the AI race-advanced chips being sold by the U.S. government to its strategic competitor, China, for a profit, while at the same time, the same government is arresting individuals for smuggling the exact same product. This illustrates a profound policy conflict. When the pursuit of profit provides the economic incentive to undermine national security objectives in a race as pivotal as AI, which force will ultimately prove stronger in shaping global policy?
A truly critical, tension-driving policy right now, and one we will certainly be watching closely. We'll see you all tomorrow morning with new headlines from major financial magazines.